It's recording. Rachel, anytime.
Hi everyone, thanks for joining us today. My name is Rachel Boyle. I'm the Executive Director here at the New Zealand Chamber in Singapore. And with me today I have Alan Henderson and Lisa Phillips, the co-founders of Erskine Owen in New Zealand. Erskine and Owen are known for providing professional advice and expertise on property investment, so they're the perfect people to talk to now about property in New Zealand. If you've got any questions during our session, there is the Q&A button down the bottom of the screen. If you use that, and then I'll put questions to Alan and Lisa at the end. So I'll hand over to Alan and Lisa now to run it. You can run it as an interview style session, talking to each other, and then chances for everyone else's questions at the end. Thanks.
Great, thanks Rachel.
Thanks Rachel. Well, welcome to New Zealand lockdown level 2. We went to lockdown level 2 Thursday last week, and I don't think I've ever been so glad to put a suit on and get out of the whole stay at home and try and work from home. So we went into lockdown level 4, which is the most restrictive phase, pretty hard and fast. And good old New Zealand was pretty eerie. And this is the first weekend going out. I took my 2 sons out and stood in front of the motorway that's near Remuera. And it was just really bizarre seeing the motorway so empty and just no cars, and we took photos sitting in the middle of the street. So I personally didn't cope too well, and I was told I was the grumpiest person in the house. And I did heaps of exercise, which was great, but I probably offset that by eating too much and drinking too much, so there were no real gains. Today we want to talk about, so Lisa leads all the research within our firm, and she's the one that loves to sit there and analyze graphs and understand what's going on, and usually on the mug that just kind of goes out and talks about it. But what's good is we've got Lisa here today, being able to share. So look, I think we should just jump straight into it and start first of all talking about globally. So Lisa, your thoughts on, just for a minute, globally where we're at in the New Zealand property market. When we can talk about New Zealand median house prices, but in a general sense, what are some of the markers of where you think we're at? We're going to talk a little bit in a minute about the specific demand and supply drivers, but you know, where are we at? We've been in lockdown. The market's gone to sleep in some ways, but you might think differently. And now we're back out, and we've had exactly a week, and we've got our own personal experience, i.e. E&O's experience of being back out in the marketplace and making offers and getting properties under contract again. What are you seeing, just quickly, anecdotally, where are we at?
Yeah, I mean, it's been kind of an interesting time. If we can kind of just step back and look at sort of where we were prior to lockdown, because our February-March market was really, really buoyant. We were really active, and the market sort of picked up considerably since the end of last year. So we kind of came into this in a really good place. We only had 48 hours before lockdown started to with the notice that we had. So we sort of had a lot of deals and transactions that were kind of mid-flight. So it was kind of interesting to see what happened in the 4 weeks that we were kind of locked down. Surprisingly to everybody in the industry, as things kind of continued, there were transactions there that had every opportunity to be cancelled that continued. So we had this, and those transactions that were completed during the lockdown period were all at sort of pre-COVID market levels. So that was kind of a really positive thing. Obviously, it stopped, certain things happening with new properties coming to market, etc., etc. So there was a drop off in sales volumes, but in terms of the sales that have taken place, a lot of them have taken place under competition. So we had some online auctions take place during the lockdown period, which was kind of interesting and well attended, good competition. So far what we're seeing, and now we're kind of back up and operating, we can do open homes again, etc., and everything is starting to sort of tick back as normal. So far what is there is positive, and is sort of representing pretty much how things were prior to. Obviously we just there is more stock has come on, which is probably largely sort of some of the backlog through the lockdown process. So it's going to be interesting to see what sales volumes do, but we probably expect maybe a little bit of a drop off, but so far so good on the pricing front.
And so here we are post lockdown level 4. our most intense lockdown level to level 2. We can get out and about. So bargains galore. Should we be out there expecting to see things at half price, go and pick them up? Is that what we should be looking forward in a general sense? Is that what we would do? Is that what you would recommend? And if so, where do we go? But we're getting inquiry from people saying, okay, surely there must be bargains out there. Can you go and bag us a bargain? And I'll take nothing less than 30% discount to market value.
Yeah.
What's your response to that?
Well, there's kind of a number of questions within that question, but I guess the kind of the bargain thing is really interesting, because anytime in a crisis, and if we look back to the GFC, it was, same thing as that, where are the opportunities and are there opportunities? So I think firstly, there are always opportunities, whether we're in a crisis or any other time, there are always opportunities in the market. And I think it's important to remember that. I guess at times like this, there are opportunities, because dynamics have changed and there are going to be, things that have shifted. And so, yes, definitely there will be some kinds of opportunities that perhaps weren't there 6 weeks ago. What is kind of interesting at times like this is people really get enamored with bargains, and that is, well, what is a bargain, I guess, but a lot of people will relate to a bargain as being something that they can buy with built-in equity on purchase. And often these deals exist because it is a property or a property type that is for some reason in low demand, and it can't be sold at sort of market levels. So you've got to be a little bit careful that you don't get short-sighted with this. So depending on what your investment goals are, if it's capital growth, if you go and chase some of these deals, you could actually risk purchasing a property that has lower capital growth potential over the short term or over the medium term. And I guess the other thing too is that if your goals are yield based goals, then you've also got to make sure that property that you're looking at that is a bargain as such, is there going to be the rental market to feed that?
And I guess if you look at capital growth, you could buy, if you run the numbers and go, it's really interesting. When I do financial planning sessions with people as an authorised financial advisor, we analyse the difference of 1%, the difference between, say, a 4% capital growth rate and a 5% capital growth rate makes over a 10, 20-year period on a $1 million property. And it's very dramatic. So it's the biggest driver of wealth over the long term. So you could pick up something with a 100K margin, but if its growth rate is 3% and something else is at 7%, you've lost out over the 5 to 10 year period. If we could start talking about specific drivers. So just as by way of background, the way we look at the market and analyze it and try to understand where it will go, where the market will go over the medium to long term, is understanding demand versus supply. Because if demand drivers outweigh supply drivers, we're likely to be in a situation where we are probably going to see prices go up over the long term. So my question really is, let's talk about some of the supply drivers that are relevant to now. So, and where we see them going. I mean, you can pick them off one by one, but we know from experience that we've got net migration, is always, population growth is always a driver. Interest rates are interesting. Interest rates are incredibly low relative to New Zealand's history, and maybe population growth, interest rates, but also at the moment, probably another key factor is unemployment. It hasn't been on the cards really for a long time as a major supply driver that we've had to talk about, but now it's probably quite relevant. So, address those in the order you want, but what are we seeing and how's it going to flow through and impact pricing?
Look, I think looking at the fundamentals and kind of assessing where those are at the moment is really key, because there's just a lot of information out there on media as to what might happen, and there is it's very difficult to get kind of true perspective on how to kind of accurately assess the market. Well, nobody knows exactly what's going to happen in the next few weeks and months. It is easy to take the fundamentals that drive the property market and assess them and go, okay, how are they faring? I think one of the big things that we need to remember here when we sort of start to look at, well, where could this property market go, and all the sort of dynamics that are at play, is that, and looking back to the GFC is a really good example of this, because we got an opportunity to look at a lot of other housing markets at the same time, and we will do this time round as well, is that New Zealand does not have an oversupply of housing, and this is critical when we're trying to assess where we think the property market could go. During the GFC, there was predictions that the property market would drop up to 30%.
Yep.
It didn't go anywhere near that, and one of the big things on reflection was that we didn't take into account that we did not have an oversupply of housing. So I think that's number one. The population net migration thing is interesting, because obviously just with border closures now, is that, you know, we're sort of looking at some slightly different patterns that might emerge in the short term. A little bit difficult to see where they might go in the long term. What we do need to remember though with net migration and trying to sort of understand what that new normal might look like, is that our government has been trying to put the handbrake on net migration for some time now anyway. The reason being is that this has been a way to try and deal with the housing supply issue. So what's kind of interesting is that we still have had record net migration for the March 2020 year. So we've just obviously finished up right on the eve of our lockdown, was sort of the end of the sort of year of looking at net migration. So that was at record highs. And then almost half of what came in that year came in from December. So we're talking about a 3-4 month period. And so if we look at March alone, which I think was sort of somewhere over 4,000 in terms of net migration in March. Now you might say, well, that's a lot of Kiwis trying to get back in the door before the doors close. When you sort of drill down and look at that, yes, there were Kiwis coming home and there were people that weren't leaving, but there was also a lot of non-citizen movement as well. So I think to sort of say that net migration is at zero, I think is a little bit, a little bit premature. Obviously, we've just got this sort of short-term situation to deal with, but I think just sort of we've got to expect that sort of in the longer term we will still have strong migration. What we do have is that we've got this backlog. So when we're looking at what the property market might do over the next few weeks and months, we've got to remember that we're still coming from a long ways back in terms of strong migration. We don't have
backlog,
the housing.
when you say backlog of people looking for housing, or?
Yeah, so backlog of people looking for housing. We don't have the supply to meet that demand.
But is that a bit of a myth though? Is that demand, because I get a lot of people asking me, but where is the shortage? People are all living in houses, so why is there a shortage if everybody's living? You don't see people living on streets. Well, there are some homeless, but how does that translate? And I know I'm putting it on the spot, but how does that translate when we say that there's a shortage? Is there really? Or is it that that's coming from areas where we've got families living with families, and for the naysayers, is it that we don't have it? It's just a statistic.
Well, I think looking at the rental market is a way to assess that. So we've had good strong rental growth continue. I think that's one way to assess housing supply. So housing requirement, whether you are buying it or whether you're renting it, is what we're trying to cater for. The rental market has continued to grow, and the demand for that has continued to stay constant. So we definitely do not have an oversupply. I think where the issue is, and where the commentary sort of centres is, do we have the right housing and the right sort of areas? Do we have the right amount in terms of property types and locations? And I think you're starting to have a compositional conversation as opposed to sort of carte blanche.
Yeah, that's fair. And and I think if you compare to the GFC that we went into, Ireland's property prices tanked enormously, but that was because they did have a massive oversupply of property where money was easy to get a hold of for developers, and they massively built out, and there was just too much supply. There were empty houses. What we certainly don't have is a plethora of empty houses. So I think that. So if you bring that up, and you've jumped across to supply as well, so I don't need to ask you about supply now, but coming back to that overall then, but coming back to demand, so, you've said, well, actually, yep, the borders are closed at the moment, but we know that demand is a real driver of house sales volumes. So population, I should say, is a real demand. Population growth is a real driver of house sales volumes. So so we actually had record levels of net migration leading up to COVID. I suppose what we've got, even though the borders have closed, what we've got now is that there haven't been any building consents issued for 6 weeks, and nobody's done anything. So it's like just a massive pause, I guess. And there's still going to be, and now of course there will be a lag time with people getting up and going. I mean, we're in Carlton Gore Road, and behind us you can see a blue sky slowly going dark, but just down the road is a construction site. And there was just anecdotally, there was a local sandwich bar that opened as soon as we hit level 3, in hope that, because at that level the construction teams could get going, and then he closed again because the owners, the developers, couldn't get hold of supplies because everybody had been locked down. It's going to take them a while to tool back up. So the diggers got removed, and it's going to be 2 months before they can get going again. So there is, although there's a lack of immigration for a couple of months, we've also got construction industry taking a while to gear back up again. Sorry.
Yeah, so well, that's true. So we will we'll definitely see in these sort of ensuing months less consents for construction. So obviously there's a lag time for when consents are lodged to when things are built. So we can anticipate that over the next sort of 12 months or so that we will see less construction on both the commercial and residential side. So obviously that is going to stop some of the supply side even further. I'm kind of jumping around with sort of on the supply and demand, but I guess the on the demand side we've got the interest rates. So we're at record lows in terms of interest rates, and what we know historically is that interest rates are one of the biggest drivers of house price growth and definitely sales volume. So firstly sales volumes, and then obviously that translates into house price growth. So interest rates have been low for some time, and that's partly helped the market that we're in just prior to lockdown. Then what we've had just recently as a result of lockdown is some sort of changes to the LVR. So Alan, you probably can speak more to.
So just going, and then I mean, talking to interest rates. I mean, I suppose the thing I was just noting then was that entering the GFC, we were at interest rates of 8%, heading almost 9% heading into the GFC, and so it took a couple of years for interest rates to drop down, and whereas we're coming into this period with banks in really good shape and interest rates already low and now dropping further. So ANZ just dropped their rates last night to 2.79% for the 1 or 2 year rate. So for New Zealand, that's incredibly low, and we're expecting the other banks to follow suit. And the Reserve Bank governor was getting a bit grumpy earlier in the week that the OCR rates cuts that they had made hadn't been fully passed on, which is what they want to happen to stimulate the economy. The importance, though, of that is that, so during lockdown, I expected to, I deal a lot with the syndication transactions or dealing with agents. I expected my phone to kind of start ringing with people that were struggling, that may have needed to offload a property, and I got no calls whatsoever. Obviously, first of all, you couldn't have gone and viewed a property, but the general feedback was agents was, well, look, some of the tenants are asking and negotiating rent reductions, but the banks have been cooperative, and also money is cheap. So we bank syndication deals, and our bankers on that front, I said, well, how are you going with all these commercial tenants and all your other clients? Fortunately, none of our syndication properties got hit. But he said, well, look, we're just taking a long-term view. It's a temporary kind of circumstance, and so we're just funding that through, and we'll just capitalise the interest and get it through to the other side. And by and large, look, there's going to be some pain, some businesses and some maybe landlords that banks won't back and will let go, but it seems to be that there is a lot of support from the banks for quality businesses and quality landlords. So the second thing, though, is that, which Lisa was starting to talk about, is that the Reserve Bank, and this is really critical to, I guess, the other demand driver we haven't talked about is the availability of money. So if it's very hard to get hold of debt, then it becomes almost impossible for a majority of investors to go out and buy property. If you can't borrow money, you can't buy property, and unless you know, you've got a couple of $100 million floating around that you don't know what to do with. So coming into the lockdown, the Reserve Bank over the last couple of years had put on restrictions on the banks to say to investors, you can only lend up to 70% of purchase price. And that certainly did its job in terms of taking the heat out of the market. What it also did is make sure that the banks came into the peak of the market with some fairly conservative lending out in the marketplace. Whereas at the GFC, we started to see the liar loans that were prevalent in the states where you could just name your income and it wouldn't get questioned. That just started creeping in New Zealand and didn't really take hold, but there was some much higher LVR loans that went out. We haven't had any of that coming into the lockdown, and so that means banks are in a much better place. And then the government also has a pretty healthy balance sheet. The only qualifier to that is that the Reserve Bank has lifted those restrictions and said to the banks, you go for it. You lend to people and investors, and you can go up to 80% or more if it makes sense. And so those restrictions have been removed, and you think that's great. With now means that the market can go in and happy days. It's a lolly scramble for money. But actually, in the background to this was that the Australian banks, who own all the New Zealand banks, they had their own problems sort of coming into the peak of the market and started putting restrictions on the New Zealand subsidiaries, saying, look, we have to tidy up our balance sheets because the Australian Reserve Bank isn't that happy. Some of the credit agencies have downgraded the banks, and so to do that, they started calling money back from New Zealand, and then introducing stricter serviceability assessment criteria. So what's happened is the Reserve Bank has lifted the LVR rates, restrictions, but the New Zealand banks haven't necessarily rushed out there and taken that on board. They're not necessarily lending above 70%. It's very case by case. And understandably, they're being quite cautious for properties that are above $2 million, residential properties above $2 million. Some banks are just at the moment choosing not to lend more than, say, 50% on that value above 2 million. So that's actually quite restrictive. We don't think that'll last. They'll just be waiting to see how the market travels this side of severe lockdown. So money's cheap, which is a positive for demand. It means that people will probably be in a position to hang on. So talking to Lisa's sort of comment about the GFC, we saw predictions of a 30% decrease. Because money's really cheap, it's going to be those people that are just really, really tight and maybe lost jobs and leveraged up to the eyeballs, but then there isn't so much of that. So that's that demand. Migration, Lisa's comment is that actually it's not completely destitute because we've had pretty strong migration, and then we've had actually what's kind of interesting around it is just these little sort of pockets that
can emerge out of this, and in terms of investment in the New Zealand market. So after 9/11, we actually had a bit of a property boom because we had all these people that were interested in wanting to invest in New Zealand, and that was actually quite significant in terms of flowing through into the performance of the New Zealand markets. And at that time, New Zealand was considered a safe haven, a great place to be away from all the world's troubles. And at the moment, we are also looking to be that country again, while COVID tends to, pervade all these other nations globally. New Zealand is looking to to be doing well. So
Yep.
I had a really interesting conversation today with some of our network down in Queenstown. So you guys will be aware that Queenstown has struggling from the tourism perspective. And what was really interesting, again, the Queenstown market is staying pretty buoyant, and I was just really interested to understand who is looking to buy, who is the market that is still feeding this. And again, there's a lot of Australians who have bought property already, sight unseen, gone unconditional on property since the lockdown has started, that are wanting to have a piece of New Zealand. And I said to these guys,
Right.
well, what are they coming here to live? Not right now, maybe in the future. So we've got this. At times like this, it does stir up a market that may not be there at other times. And of course, we've got our Kiwis that will come home.
So that's probably a good segue into starting to talk about drop down from where the market's at and what's driving the market. So just if I could wrap that piece up, demand versus supply, I always think about that graphically and think of a scales. Supply, we don't have a massive oversupply, so we're unlikely to see that the supply side drive a massive downturn in prices as it did in Ireland. On the demand side, it's actually not as bad as probably what some people might think. Yes, we've got unemployment, and we've got to see how that plays out. Yes, we've got we haven't really talked about the tourism and hospitality sector, and that will have an impact in some areas. How it will play out in the I guess the macroeconomic sense within New Zealand is yet to be seen. It will have an impact in certain areas, but will it be localized or isolated? But overall, we've got some fairly positive demand drivers. Reserve Bank government being very supportive, making it easy for banks to lend money. Banks been in pretty good shape. Are banks playing the game and lending enough money? Well, that's always a $60 million question. We've got interest rates that are incredibly low, so that's making it more affordable to buy. And net migration is still pretty buoyant. So, I've got a lot of people that have come into the country. Starting to talk about where and what you would buy if you were an investor. And so you've just talked. Maybe we can come back to Queenstown, but I mean, so Lisa runs the buying team on the buyer agency side. So Erskine Owen, we have our buyer agency work. So we're licensed under the REAA, and so we have expats in Singapore that might come to us and say, build us a property portfolio, and then we're then their agents, and we'll go out and do that buying, and Lisa directs that. And your team got a property under contract last week or earlier this week in Hamilton, and you were saying it was a multi-office situation. What's the story from that? We've come out of lockdown and we've got multi-offers going in Hamilton. What's that about? And does that mean that Hamilton's a place to buy, whether it's residential or commercial?
Yeah, well, I guess just to speak to that is that's really just a carry on from what we've been seeing prior to all of this. We had multi-offer scenarios going on through lockdown as well. So this is really just picking things up where they left off in that sense. I guess the thing to kind of address when people are a little bit concerned about, well, what is property pricing going to do? Where will prices go? And look, I have read that property prices are going to drop anywhere from 6% to 15% over the last few weeks. And as I touched on earlier, as the same for the GFC, we just saw everything being reported. And what actually ended up happening through the GFC, and I think the same will happen here, is that you've got to understand and look at the market through the compositional differences. There are going to be sections of the market that will soften a little bit, and there's going to be parts of the market that stay more resilient, and that will be some locations will stay more resilient than others, and we'll also have property types that stay more resilient than others, and then we're going to have price bands as well that are going to perform differently. So I think it's really important when we're trying to look at the market is we've got to understand what are the areas that are going to perform better and what are the areas that aren't. So if we kind of reflect on the GFC, and what we saw then is that when the GFC hit, we saw a lot of investor areas at low quality housing in the lower end of the market liquidate, and then we had an oversupply of housing there, put a downward pressure on pricing, and we saw some price softening. But what was interesting was that there were these other sections of the market that continued to perform fairly well and didn't see the same level of softening. And there were properties that were in the a higher end of the market, I'm not talking high, but a higher end of the market, maybe your second home buyer market. There were properties that were of better quality in terms of quality of construction, and so all of a sudden these stats change just through looking at different parts of the market, different property types. And so what we do find at times like this is that where you've got property types that are in at risk of oversupply, that's usually your intensified forms of housing, they are more at risk.
Like apartments.
Like apartments and your townhouses, they're usually more at risk than say your you know, your standalone family homes. So it's really important that we you know, that we look at the market through that. So when you say, oh, the market's going to drop 10%, we know that some parts of the market may soften, but not all parts of the market will.
And I think Toby Hunn, who works with us on the client, who's client facing, we were chatting this morning, and he said, oh, there's been a massive flight to quality equity stocks like Google and Amazon, and their prices are just ramped straight back up again. And you know, that's a Warren Buffett story, isn't it? You know, he's always, I'd rather buy buy fair price for a quality business than a bargain. And it's we've always said that about property as well. I'd rather have a property at a fair price than a bargain that's just not going to go up in value. And so then you know, talking about that practically, then I know that when you're buying residential property or recommending a buying brief for residential property, you like to chase where the first home buyers are going to be, and then even after that, it's not all suburbs, and it's not all streets, and it's not all types of properties, because you try and direct our clients towards properties that are going to appeal, that are going to be the types of properties that, so in that second home buyer market, that that a family is going to want to live in. And is that what is happening in Hamilton? Is that what's driving that? Is it that it's becoming the second home buyer market where people want to be?
Well, I think there's all you know, different. Hamilton's not the only area that is performing, but I think what the point that needs to be, you know, reiterated firstly is that you need to buy a type of property that is conducive to achieving your goals. So different property types are conducive to achieving you know, capital growth. Other property types are more suited to generating income and have higher yields. So it's, in the first instance, you've got to look at what your goals are, and you must stick to that. Again, you know, it's easy to get distracted. But where you have property that is quality property, so what we try to do with clients, regardless of what their goals are, is to build what we call a demand profile. So when we look at that brief that we go to document, we want to know that that brief on paper looks like something that a lot of buyers are going to want to buy, whether they be looking to buy, but also the same thing applies for when you turn around to rent that property. Is it going to be you know, have good rental demand? So that is what is important. And if you have quality property that is saleable, it will remain saleable in any market. And I think that's important to kind of remember that as we sort of get, you know, we soak up all this, you know, stuff in the media and all the dynamics that are kind of fast changing here, is that at the end of the day, quality property is still saleable and will hold good. So
just touching on commercial for a minute, and just thinking about that, because, you know, syndicating property, we do that, and that's often quite a yield play, and that can suit people with money, people with equity that they want to place it somewhere and get income, because we're getting returns of 7%, 8% on equity. And so talking about commercial, you know, again, for a client this week, we've got something under contract with a 10-year lease on it with a listed company at 6.5%. And are we expecting to see commercial yields soften more than perhaps residential? I mean, that's under contract, and it didn't feel like that was at a great discount to where it might have been pre-COVID. What are we expecting, or is it the same story that it depends on what it is? And is it that that it becomes far more about the tenant.
Yeah, I think that's right. I think what we're going to see is a sort of shift in the way that we value commercial property. What's become really evident through this is not just the strength of the tenant in terms of from a lease perspective, but the strength of the tenant in terms of their industry and their business, and how viable they are through situations such as COVID. So I think we will be it will be more about looking at the tenant, not just at the lease. And I think that's I think we're seeing that, the little bit that we've done since lockdown is that I think that is kind of what is emerging.
Yeah, I mean, we've got a friend who owns a meat business, and so he's in the essential services industry, but he's suffered a bit during. He'll get back. He's a determined guy, and he'll get back there and he'll get back to full revenue. But it's been a tough 4 weeks for him. So although he's in that essential services industry, it's no guarantee that that's a tenant that is just absolutely immune to this lockdown. So I think it is really important that you've got to understand, you've got to do your due diligence on the tenant far more than perhaps what was being done pre-lockdown. So I'm just really conscious that we've got 40 minutes for this phase before we get into Q&A. And so we've just got about 4 minutes left just to maybe start wrapping up and covering off some sort of areas that we haven't talked about. I think we've covered off commercial and residential. Just maybe touching on Queenstown. So just finishing off some of the areas that we like. We certainly like Hamilton. We think that's got potential. Auckland obviously is a bit of the economic engine of one of the economic engines of the country. Queenstown, we love obviously going to Queenstown, but we think it's an amazing investment opportunity down there. But what now? Because it's obviously you'd be a fool to say that it won't be affected by COVID, because it's essentially a tourism and hospitality destination. So are we going to see carnage down there, or again, is it going to be localized?
Yeah, I think that's kind of interesting, and I think what the best way that I would put it is, I think we're just going to see sort of a recalibration. So yeah, no doubt the tourism aspect has definitely sort of created a deficit in Queenstown. What seems to, and I've talked to a number of people in the last few weeks across a range of businesses, and what seems very clear is that we've got the sort of the tourism workers. So yes, they've lost their jobs, and that's an issue, but they don't want to leave. They don't want to leave town. So it's not like we've got this massive exodus of people. So while some people have left town, there is a big contingent of people that do not want to leave Queenstown. They want to make that their place to live. So that's important, because that feeds demand. That demand is still there. There is going to be a recalibration around the tourism activities, and I think that will take some time. I'm fairly confident that we will see a sort of a shifting, and then in time to come we'll see the Australian market open back up. Bearing in mind that while the global market for tourism in Queenstown is for a lot of businesses only 30%, the 70% is still made up of Australia and New Zealand. So once we can get Australia back up and going, then that will sort of feed the Queenstown market. In terms of what we're seeing with housing, again, the people that are looking to buy in Queenstown are coming from other areas that are not necessarily dependent on the Queenstown economy for their work and their income. And a lot of the areas that are outside of the town centre seem to be at this stage sort of performing pretty well. The demand is is still fairly solid. Yes, there has been a little bit of sort of retrenching on the and rentals. That I think is going to be a short-term thing. There is a lot of rental supply there at the moment. Again, that is mostly impacting the areas closer to town, properties that are more conducive to being rented out to single people, young people that are doing hospitality and tourism work, as opposed to families that are living further out in the established suburbs.
Cool. Well, I'm going to hand it back to Rachel now, because we're coming up to 40 minutes. So Rachel, I think you might want to jump in and take over, and there might be some questions there for us, but I'll hand back across to you.
Yeah, absolutely. Hey, thanks for the insight, both of you. Certainly it's not as gloomy a picture as maybe I was expecting for property in New Zealand. We do have quite a few questions come in. I'll just work from the top, actually, rather than try and organise them as we go. First one here, are you seeing distressed and highly leveraged portfolio holders? And I think you've answered the question there on interest rates.
Yeah, I think this is the question that people are asking, because it kind of links in with getting a bargain. I don't think we're going to see this the distressed sales that we saw during the GFC. Reason being is that if we go back to the GFC for a minute and look at what happened there, is that the economy was in a very different place. We had interest rates were really high coming into it. The LVRs were in a very different place. People were highly leveraged. It was a banking-led crisis. There wasn't the support from banks. So there was all these things that basically sort of led to sort of mortgagee sales. Well, I don't think we're going to see that in the same way, for all those reasons that we're coming from at a very different place, and people are not as highly leveraged as what they were. And we had 2013 was when our LVR started to change. So we've had sort of 7 years of trying to sort of get people into a different place in terms of leverage. So look, that's not to say there won't be some, but I think what people are sort of trying to understand is, are we going to have a cascade of that? I don't think there's evidence to see that at the moment.
Yeah, I mean, there's always going to be mortgagee sales. There's mortgagee sales. I mean, I left corporate and back in 2000 roundabout and started trading property, and would always go to the mortgagee sales. There was always stuff to sell, but there's always mortgagee sales, and who knows, this is often an opportunity for businesses to move on underperforming staff, and there's a good reason. You don't really have to go through a long-winded dismissal process. And same thing, banks can use the opportunity to move on businesses that perhaps they wanted to move on anyway, and it's a good reason, so it doesn't look so bad. And interest rate component of it, negative interest rates. Look at could the Reserve Bank go there? Possibly, but I don't think that's going to hit the this is my personal opinion, could be wrong. More often than not, I've been wrong about my predictions on interest rates. And I don't think the retail banks are going to get down to negative interest rates. So, but who knows? It's a weird world, right?
Yeah, and got a question here around investments in mixed use developments. Do you see any value moving ahead and holding retail space, or is that a risky place to be?
Yeah,
I think one of the things that we've got at the moment with all commercial property is that in the last 2 years we had a real boom in commercial construction. So we're actually holding quite a lot of stock across all sectors of commercial. So I think that's one thing to consider when you're looking to hold something like retail, is that we do have possibly an oversupply. Again, it depends on the location that you'd be looking to hold it, but I think that's definitely one consideration. Obviously, at the moment, retail in terms of its risk profile, having been through COVID, yeah, definitely another thing to consider.
Yeah, and what about legislation? Is there anything kind of in legislation coming up? I know we've seen kind of insulation and things on rental properties recently. Is there anything more coming through there that you're aware of?
So the installation regulations have been passed and they came in July last year. We now have a Healthy Homes Guarantee Bill that has just, because of COVID, has been postponed in terms of meeting those requirements, which is really just around keeping homes at a particular a minimum heating level, so largely around heating in living rooms and ventilation. At the moment, we have a COVID Amendment Act in place for the Residential Tenancies Act. So basically we've got a few sort of limits on what we can do around tenancies at the moment. There's a rent increase, there's a freeze on that at the moment, and also there's just a few liberties that are extended to tenants right now in terms of being able to stay in properties even if they can't pay full rent. So it's just the period that you have to kind of take them to tribunal and evict them, that period is a little bit longer. So we're hoping that legislation won't stay in place forever, but it is there at the moment.
Okay, we've got a couple of questions here about investment regulations for overseas buyers. So one particularly here about for Singapore citizens. Are you guys able to answer that?
New Zealand has a agreement with Singapore that Singapore residents can invest so the legislation changed about a year or so ago, where non-New Zealand residents couldn't buy property in New Zealand unless it was off the plans, residential off the plans, or commercial property. But that didn't apply to Singapore residents, and likewise New Zealanders can buy freely in Singapore. So Singapore residents can still buy, and there's nothing holding them back from that. So no, they absolutely can, and we may even see some relaxing of that.
Yeah. There's another question around restrictions for foreigners. You've kind of covered a couple there. Question here: besides residential, what other types of property do you think would be a good investment in New Zealand?
Yeah.
So is it agricultural, warehousing, industrial, etc.?
Yeah. So in terms of residential, well, after residential, you really talk about commercial. So, well, you can go agriculture. Like you can go and buy a farm, and that comes with different risks and different work involved. So it's perhaps not as straightforward as your typical commercial. And then you drop down in commercial, where you've got industrial as one that is often quite popular, retail, and then office. So retail is risky, I think, but some retail might be okay, like bulk retail. And so I don't think retail is dead, but you've just got to be really careful. Office is fine. I don't necessarily buy into the whole thing that, right, okay, so now everybody knows how to use Zoom. We're going to see offices empty, and Deloitte's going to have their office space requirements. I just don't think it'll happen. I mean, I got really, I got a bit bent out of shape mentally. Not really. I just got told that by my wife, that I got bent out of shape during lockdown. And I'm the kind of person that likes the interaction with a team. And so I think there'll definitely be some people going, oh, actually, maybe we don't need as much space as we think. But then it's not that easy to get out of leases. You know, you've got 6-year leases. I just don't think there's going to be the massive exodus and vacancy rates on office building. We're humans. I think, if anything, lockdown has proven to me that we're actually, as humans, we like to interact and we like to shake hands, and we like to hug, and it's just human nature. So, but in terms of simplicity, industrial is perhaps the easiest way to go. So you can get, commercial. We syndicated the Watties distribution centre in Hastings last year, and that's just simple. It's the size of about 4 football fields, but it's just a tin shed at the end of the day with some sprinklers in it, and there's not much that can go wrong, and it's got a decent length of lease on it. So types of properties, and then you go to the industries. So essential services, Watties were just flat out, and so they didn't ask for a rent reduction. Keep our investors happy. So within warehouse, you've just got to pick the right industries, and if anything, it's about doing your homework on the tenant and being very, very sure about who they are and what they're capable of.
Alrighty, a question here about Christchurch. So it's saying there's been an oversupply since the earthquake, and this person's house has grown very little in value. So I guess a comment on that. And then the second part of the question is, I'm looking at buying in Tararua. What are your thoughts on prices there going down? So Christchurch, Tararua, what do you think?
I'll let I kind of don't mind. I'm going to let Lisa answer this question. Residential, I wouldn't touch down there, but commercial, I'm kind of interested. But Lisa's firm opinion, I'll let her share her firm opinion about Christchurch.
Is it for sorry, where's that? Is that for commercial in Christchurch?
Well, no, residential.
Residential.
Property here, residential oversupply.
Yeah. So is there an oversupply at the moment? What's going to happen to house prices in Christchurch?
Yeah, I mean, Christchurch has been, you know, it's sort of been a little bit unfortunate. I think it hasn't really fully recovered from the earthquake in terms of its sort of supply-demand balance. And I think that for the reasons that it hasn't quite got the sort of supply-demand balance back to where it should be, like other sort of cities do, I think that for me, purely from an investment point of view, I probably wouldn't go to Christchurch. Now, having said that, Christchurch is a main centre, so we were looking at doing a risk assessment on areas to invest in, particularly in the light of COVID, is that, you know, it is a city of diversity, and from that perspective, yes, it's got things to offer. But I think if you're going to look to invest in Christchurch as a main centre, I think there are other main centres that would have more to offer, just because the supply-demand balance is a little bit better at the moment.
Okay, and then what about Tauranga? What are your thoughts on property prices coming down?
From a residential point of view, Tauranga is, you know, it's been very, very popular, and prices in Tauranga have grown, you know, considerably in a short space of time. From an investment point of view, we're getting a lot of pricing in Tauranga is starting to look, you know, somewhere between Hamilton and Auckland, but some of the capital growth potential in Tauranga may not be as strong as in say Hamilton, and then we've sort of got Auckland as, you know, your big sort of economic engine in terms of, you know, main centre. So my question to people when they talk about Tauranga is why. It's not that it's bad, it's just why. I think there are other areas that have got better trajectory in terms of capital growth at the moment, if that is why you're buying. And if you're looking for yield, again, I think there are other locations. Tauranga is very, very popular, and if you end up buying in Tauranga, you're not going to go wrong over the long term.
Okay. A question here around the percentage of deposit required for a mortgage is going to be relaxed a little. Will this be the same for investment properties, or is this mainly going to be for homeowner living in a property?
Yeah, so that's where the Reserve Bank, we're talking earlier about, the Reserve Bank has lifted it. So they've lifted that restriction for any type of residential buying, whether it's investment or whether it's home buying. So okay, the banks are now permitted to lend to investors up to whatever level they want to lend to. That's not our issue at the moment. The banks are just at the moment being cautious, and they're being selective. So we're waiting for the absolute mandate coming out from each bank to say, yep, we're going to take that on board. They don't have to. They are entitled to select their own lending criteria. So they're permitted to lend up to 80% or more. Past 80%, they've got to go and get special types of insurance that becomes more expensive. So they can lend up to that level, but whether or not they actually choose to do so internally is a little bit sector by sector, case by case. So we're not seeing a carte blanche decision across the board to lend, you know, to lift that restriction.
Yeah, there's a couple of people here asking about longer term trends, if you like. So obviously COVID is recent and the banks have been really accommodating. But do you see a fundamental kind of shift in the property market in the next 6 to 12 months? Obviously things will start to kick in, possibly people losing their jobs, unable to service the mortgages, that kind of thing. Do you see that hitting a bit further down the track?
Well, I'll give you my view, and then Lisa might want to give her own view. Is that I'd call longer term 5 to 10 years. That's for me is long term. The next 12 to 18 months is shorter term. Yep, we've talked all about. Well, Lisa's talked at length about how there's going to be pockets that will be hit. I fundamentally, so we invest for the long term. We're not traders. Our clients, we struggle we get nervous about people that come to us for a plan and they've only got 3 years left. Perhaps because property performs long term, and that's where you see the real gains. So long term, I look at the fundamentals of the market. Do we have fundamentally some changes in the demand and supply drivers? And I'm not seeing that. So we've talked about net migration, availability of credit, and especially supply. I'm not seeing any of those things long term being impacted. In fact, there's perhaps long term more in favour of demand than against it, because if you think about New Zealand being a preferred, somewhere that's safe, that we can come to, that we can lock out pandemics, that we can avoid Northern Hemisphere conflict, perhaps that's going to drive more and more demand. So no, over the short term, I'd be a fool to say that the property market's going to go up in the next 12 months. So, but that's, I think, long term. So I don't know if you want to add to that.
Yeah, no, I agree with that.
Yeah.
Okay, another one here. What's your top tip recommendation on the best options if someone had $1 million to spend in the New Zealand property market?
My top tip for that is to get in touch with Toby, and he'll sign you up, and we'll find you a great property. But that's Lisa. Do you want to perhaps address that? The top tip: if you had $1 million, where would you go? If you had $1 million to spend, where would you go? What would you buy? Where would you go? And you probably don't want to. You probably want to give a more academic answer, but if you don't want to do that, I'll answer.
What I will say is I think $1 million is actually a good price point.
Yeah,
I will say that I think that's good. There's a ton of great places that you can take $1 million to. Again, what I would be wanting to ask is what is your goal? What are you trying to achieve?
Yeah.
But just in general terms, if we go back to what we sort of mentioned earlier about sort of different price bands performing differently, if you can come in with $1 million to invest and that's a spend level that you've got, I think that's a good spend level. There's a lot that can be done with that.
Yeah, and being a financial advisor, that's where we start. What are your goals? If you're chasing capital growth and you've got $1 million, then I'd look at everything, but a little bit on the lean side for commercial, but really good for residential. Jump into residential as long as you've got a long term. You've got years to play with.
Okay, and we've got one here. Just possibly a correction from before. Isn't it correct that Singaporeans can't purchase farms without obtaining OIO consent? I suspect it probably is the case.
Well, yeah. Well, it actually depends. Well, and probably yes, because a farm, when we're talking about a farm, it's of a certain size and spend level. So probably, but it does just depend. And but I wouldn't let that scare you off. OIO is not there to stop investment. It's there to make sure that the investment is right. And there's plenty of solicitors that are very adept at taking people through that process. So just because there's a process, it doesn't mean you won't get approval.
Okay. Now I think we've actually come to them. We've answered. There's a couple more here, but I think you have answered them as we've been going through. So I won't put those to you directly. So I'd just really like to say thanks for your time today, both of you. It's been really informative, really interesting, and I guess people can get in touch with you at Erskine Owen if they want to know more and want to invest $1 million in the New Zealand property market.
Yeah, no, absolutely. We'd love to help out and happy to chat in the first instance as well. And Toby Hunt is probably the best person to get in contact initially, or Wendy. Got a couple of people there that would Wendy, Ryan, Kidd. Thank you, and good to talk to everybody in Singapore. Albeit we can't see your faces, but look forward to getting up as soon as these borders open and buying you all a drink.
Thanks, Alan. Thanks, Lisa. Thanks for your time today.
Thanks, Rachel. Bye.
Bye. Bye.